Hey everyone, it is Friday. I'm here with Doug, and let's get the party rolling. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with my good friend Doug Hagren. Hey, Doug.
Hey Kirk, how you doing today? It's always a pleasure to be here. There's no place I'd rather be than spending time with you, Kirk.
Oh, that's so sweet, Doug. If only you told the listeners what you really thought.
Yeah, I was gonna say now that we've gotten all the lies out of the way, we're gonna spend the time telling the rest of the listeners the truth.
Yes, let's talk about politics, Doug. That's a good way to start that conversation.
That's right. Hey, kissing babies.
Yeah, kissing babies, stumping all the way. All right, well let's start this week, and I titled this "The Sky is Falling" or just the market, just in jest because I've been getting a lot of comments, thoughts, and just curiosities about what's going on, and so I wanted to tap into it without tapping into it. So what I find fascinating is people get stuck in some people would call it time dilation. And you could use this to mean many different things. I'm going to try to describe it in a way that hopefully is illustrative for people. Time dilation is when you look at something, you naturally think that it's going to go on forever. So there's some sort of recency bias in there, like, oh, the market's up, it's going to go up forever, right? Um, which is great, right? Or another version of time dilation is, oh yeah, AI is going to like change the whole world. Yeah, maybe in the next 20 years, right? So we look at things and we either have a too long of a time period or too short. And we can't, in our mind, when we think of things quickly, we can't digest exactly what that time frame is. And this actually comes true with business owners. So if anyone here is a business owner and you've done some business planning, what you'll notice is your 1 year projections are really off. You overshoot your 1 year, but you typically undershoot your 5 or 10 year. Because in 1 year, you think, oh, I can do all this stuff. In 10 years, you're thinking about the 1 year adding on a little bit more. When reality is, it's the opposite. You can do very little in the front end because you have to ramp up, you have to create systems, processes, different things. And then if those are working, then it starts to ramp up. And so I was just working with this company recently and they're like, oh, I can't wait to like bring on like 20 new clients. And they have like big high-end clients. And I was like, why do you plan on year two? Year one, plan on getting your message right, plan on getting your process right, plan on this, that, and the other thing right. Year two, that's when you should plan on hitting the goals because you're going to underperform and you're going to be depressed, right? Because you think, oh, I couldn't do it. No, it's normal, right? So this time dilation acts the same way. So I'm going to use this as an example with the market because we haven't talked about the market yet. So if you look at the markets, okay, and I'm going to look at the S&P 500 as an example. If you look at the S&P 500 since pretty much the beginning of 2021, so like Q1 2021, that time period until today, people are like, oh, the market was up a lot. Was it? Okay. Well, from 2021 in the first quarter until 2022, yeah, there was a little bit of a gain. Last year, erased it all. And then this year, oh, it's up a lot, but now it's down. Well, actually, it's been all within a range for the last 3 years. So we've been within a 3 year range, but depending on when you look at it, it looks great or terrible. And I don't want to share the chart because I'm not sure I could do that very easily, but maybe Doug can send me one of the S&P in the last 3 years. But it's just, if you look at it from that perspective, right, you could say, well, it's up, it's great, it's terrible. Well, depending on how you look at it or when you look at it, you're going to think I'm doing great or terrible. When reality is you haven't moved at all, right? Yeah, you've moved from day to day, but for 3 years, you've gone nowhere. And so, yes, from the day one of 3 years ago till today, yes, you've made some progress. But through that period, it's bounced around a lot. I mean, I think we hit a high on like just looking at the ETF of approximately 480. And during that period, I think the low was right around 350. That's a huge difference. Huge difference. Now, is that where it is now? No, I think as of today, it's like 430, right? It's somewhere in the middle. But if you're thinking that, hey, the stock market is going to go up 6% a year, or 8% a year, or 12%, or whatever imaginary number you put in your head, that's not going to happen, right? over time it happens, like over 20 years, maybe that's what you can expect. But in any given year, you look at it, you're like, oh, I'm not doing great. Oh, I'm doing great, like depending on the day. And so the time dilation is really hard for human beings because we don't have perspective. Now, some people do, right? If you put a lot of time and effort and thought into your portfolio, then it's probably a little easier for you. But for most people, it's not easy. And you get these calls like, why is my portfolio going down? Like, since when? And it's like, is it from the calendar year? Is it from a year and a half ago? And sometimes I get these calls and it's like, well, for the last 18 months, the portfolio's down. I'm like, well, let's look at 18 months. Well, okay, we've outperformed the S&P 500 and you're still down. Like, okay, what do you want me to say? Like, if you pick imaginary numbers, and I'm not saying they're wrong, right? And this is the point, right? And if you pick some imaginary date and say, well, as of this date, it's done X, it's done great, it's done terrible. Has it? Does that date even matter? And to put it in context, think about the calendar year. Okay, January 1st or 2nd or 3rd, whatever the first day is in the trading. Say January 2nd until December 31st. Somehow, some reason, because of the calendar, I want to be clear, I'm not imagining this, because of the calendar, but for some reason we picked those dates and they're magical dates, and because they're magical dates, we're all going to peg everything to those dates. Think about how absurd that is. Now, on one level, you say, well, how else are you going to track it? True. 100% true. You have to track it somehow. So I'm not saying there's a better way. But what I'm saying is what that does to you as an investor is it causes you to look through the lens of a calendar year as if that is important. It is totally unimportant. It is only important because that's when the statements come out, because that's when the brokerage firms send out their performance reports. That's because people are asking for the quarterlies. There's a whole culture designed around this. And it's not right or wrong, but you should understand that those dates really don't matter. What matters is your portfolio growing in the context of your goal? If your goal is to index and the index is down 30%, you're like, why is my portfolio not growing? Obviously, there's a misalignment there. Now, if your goal is to make 5% a year and you're buying treasuries and you're saying, why is my portfolio not up 30% with the index? Another misalignment, right? So there's no right or wrong answer. It's a function of, is there a misalignment with expectations? And the time dilation plays a big part in that. Are your expectations timed to a realistic time frame? Are you over or underestimating what that is? And is it reasonable, right? If the market's down, like last year, virtually all markets were down. There were some that were up, but across the board, stocks, bonds, whatever, pretty much almost everything was down last year. So should your expectations be, why did I not make 10%? Or should they be, hey, I didn't lose 30? Like that's just a question you have to ask yourself. And if you're thinking, I still should have made 8%, then you need to be re-educated in how your portfolio is designed, right? Maybe what you're doing should produce 8. Like maybe you're lending money at 8% a year and you're not getting 8. Okay, great. That's a great perspective. But if you're in the index and your expectation's 8, then you should go back and revisit, should I be doing this in the first place? This is the first question, right? And this comes up in times like this, and I'll come back to it. The second question is like, so basically, should I be doing this in the first place? Is it aligned? And do I need to change it? Now, the first point I want to make is, should you be doing it? And I make this point, I'm going to hand it over to Doug before we get into the news, is what happens in our industry. So we're fiduciaries. Doug and I are fiduciaries. So we have a very high standard of care when we work with clients. And we have a lot of liability goes in that. It's not like brokers who just sell you a product and they can never call you again because they don't care. Not that they don't care, but they don't have to care, right? And so tendency is they don't care. So if you look at it from this perspective, right? If the market is an all-time high and you do a risk tolerance questionnaire, so basically assessing what your tolerance for risk for ups and downs, your risk tolerance is going to be pretty high. Because the market's at all-time high, there's no risk anywhere to be seen. You're feeling like $1 million, maybe you're worth $1 million, but you're feeling great. And you're saying, yeah, my risk tolerance is great. I can deal with anything. Now, if you take that same person, have them answer the same risk questionnaire, when the market's down 50%, I guarantee you with a very close certainty that at least 80% of the people are going to say, no, I think my risk tolerance is pretty low. Now, there's some people who say, I don't care because I understand math and the markets and I don't care. That's the 20%. 80% of the people are like, no, I don't really like risk. Risk isn't good for me. Now, it's only because of that time dilation that matters. If you'd asked them before, one response, ask them later, another response. It's the same person, right? It's just if you ask them at different points in time, you're going to get a different answer because they're emotionally involved differently. If you get somebody who's emotionally detached from their investments, they can answer it honestly. They'll say, no, I'm still high risk. It's great. I can deal with this. I'll just put more money in and I'll be fine. Somebody who's maybe a little more malleable, they're going to say, oh yeah, I have a risk tolerance of like 5. Really, they're a 2 or a 3. But they said 5 because they want 15% returns. Now, a lot of advisors say, oh, you want 15%, you're a 5. It's not really how it works. But, if you're a 2 or a 3 and you want 15%, that's a conversation that needs to be had because you're misaligned with expectations. So realistically, during times like this, people's tolerance for risk is going to be lower because we're off the all-time highs. The market's sold off in the last few months. Everyone's feeling a little queasy. Is the stock market falling? I don't know. Doug, what do you think?
Well, is it falling? I mean, sure.
Is the sky falling?
Is the sky falling? Well, I mean, part of the problem that we have now, and this is the huge disconnect is you've got more information at your fingertips than we've ever had in history, right? And that could be a wonderful thing because it can allow you to get around those barriers of information access that have predominantly allowed those in certain positions to be able to control the narrative and the message that you get. I mean, back in the day, even access to investing, you had market makers, which still exist. They controlled everything. Everything had to go through your broker. You had to pay a commission to get someone to do a trade for you. Now you can get that right online. Same thing with information. All the stuff that we're hearing right now, but with that responsibility that we've now received, unfortunately, is also the responsibility that I think the majority of people can't handle in order of trying to figure out how to disseminate that information, because it also allows anybody to be able to provide information and narrative around any subject without any real ability to disseminate the credentials of stating it, right? So we hear, you've got the mass, we don't want to listen to mass media, mainstream news tell us this. So we listen over here and this person's going to tell us. But what gives you any ability to, what gives that person any ability to disseminate information that's accurate too? They could be completely making it up. And so when it comes down to it, the narrative that you're getting in terms of whether it's politics or war or the markets, there's so much more noise. And that makes it even harder than ever for you to be able to feel comfortable with where things are and the decisions you make. And it's made us more and more and more impatient. I see this every day in the world around me where people can't even have conversations without 30 seconds going back to their phone and locking out, right? So is the sky falling? Well, yeah, if you want to listen to certain talking heads out there and news sources, yes, the sky is absolutely falling. This is the beginning of the end. This data shows you that the world is completely imploding. You listen to other sources, it's going to tell you it's fine. I read, there's plenty of stuff that came out in this past week that said that a number of things that are occurring right now that if they align could actually end up being bullish and could put the market on a tear, right? That's the problem, is the predictions. But we are almost paralyzed now with the amount of information we get, which really means that we have to become more responsible for pulling ourselves away. And I hate to say that because this is very similar to heroin addiction. And we're back, Craig. We're back.
Oh, you're always taking it back to heroin.
We're always taking it back to heroin. But it's
didn't you get that taken care of?
Yeah, I've got that problem fixed. Unfortunately, there's plenty of other people out there that are still addicted to it. But it's like going to the addict and telling them you need to pull yourself away from that source of addiction. And the news that we're hearing and the information that we get, it's very, very difficult for most people to pull because they've got this program to a science. I mean, go watch the social, or is it the Social Network?
Yeah,
whatever.
Network.
Yeah, that talks about how they've programmed us to be hooked into more and more. The greatest thing that's come out now is Reels, right? I mean, I think I don't know where this started, if this was, came off TikTok but now everybody's got it. Snapchat's got it. Facebook's got it. Everybody's got these Reels. That snippet of information, hook, and you go from reel to reel to reel to reel. The news and information, and whether it's finance or anything else, has been programmed to be able to do this at a better and better pace. And it's hard for us to pull ourselves away. But going back to what you said, is the sky falling? Yes, we also end up in these vacuum chambers where you're going to believe what you're going to believe. And there's plenty of people who are going to tell you what you want to hear. The reality of this is there's so many different variables that if everything that people were predicting was going to come true, it would have already come true. Okay. I mean, you look at the data, this market should have crashed long ago, but they haven't. You look at new information that's come out, about a recession. They always admit we're in a recession after the fact. Well, guess what? If you look at certain data, we're already in a recession, but yet the market's still going strong. Now we've got a war. This war was, this war was created by people, bankers that are trying to get to help themselves because they're in such financial trouble. I don't know. Maybe that's true, but that's certainly a narrative that's going around. The reality is like you said, Kirk, people are much more risk adverse than they are risk tolerant. And you don't know that, unfortunately, until things happen. So when you're asked about, what do you think of the markets? I'm fine. I like taking risk. I like the upside. Well, yes, that's because when times are going well, you have a tendency. We as humans have a tendency to fall into greed, and the greed is also known as the fear of missing out. Right? I want to make more, and that's a hope strategy. And if you've got a long term time frame on this, that's where you'll be sold that spending this time frame, giving you the ability for whatever happens in the market to come back. Now, you and I have talked about that's not always the case, right? Because lost time is lost forever. You don't necessarily get that back. You have to be able to get back what you would have gotten during that period and add to it. So there is risk of lost time. But, at a simplification, if you've got 20 years, what happens today, does it have a huge impact on you? Not as much as someone that has 5. So if you need the money, then you also need to be prepared with what's going on, in where you have exposure to understand that, look, you can't afford necessarily the time frame to come back on this. You need to be aware of those risks and those perceived threats, and you need to take action on that in a different way than someone has more of a time frame. But either way, you have to understand that you can't sit there and prepare for hope for what greed could give you. You always have to preparing for what is the worst case scenario that you could be facing, and be prepared to prevent the risk that could happen there. And I think that's the issue. So is the sky falling? I don't know. I'm not here to make predictions, but if you need money in the next 5 years, I'd be very careful about having exposed right now, no matter what your situation is.
Yeah, I think that's the truth of it, Doug. So I'm gonna share one of my things here on the S&P 500 before we share a few other things, because I think this is an important chart. So this is basically, and for those of you who are listening, just follow along. This is basically, and you can go to the website and we'll have it on there. This is basically a chart of the S&P 500 for the last 3 years. So if you'll notice, like right here, this is the start of 2021 where this marker is, and this is basically the end of Q1. So if you look here, even if you take it back to the first year, it's still within this range, right? And this is the box. This is where it's been for the last few years. It went up, then went down, then went up. It's going down and up and down. And you know what this reminds me of, Doug? Oh, what am I thinking? Oh, the 70s. This reminds me of the 70s. You know what else it reminds me of? Oh, the early 2000s, the aughts. It reminds me of that too. This is I
haven't heard that since the last time we talked about it.
Oh God, we talk about it so much in the show, and I know the listeners hear me, but I have to keep saying it because if I don't, people won't really believe me. They'll say, "Well, you didn't say that." Like, well, I actually say it every week, so you can't claim ignorance. And I think that's my policy. You can't claim ignorance on this show, and except for us, I think we can claim ignorance. But but I want to go over a few things because I think that was just the index, and I think it's important to recognize kind of what's going on in the markets and why. Is the sky falling? Not yet. It could, right? We could be Chicken Little and the sky's falling, and oh my God, it's crazy. We're not there. And I'm not worried. I'm not getting excited. Let's put it that way. It's not at the point where I'm getting excited. I think if, looking at the chart we just shared, if the market takes it down to where it was in October of last year, I might start to get excited because if the market's range bound, that could be exciting because there could be some good opportunities there. Right now, we're flat in the middle. We're literally right in the middle of the range. Couldn't be any more in the middle than we are today. That's unexciting on all parts. That basically says we have an equal probability of it going up and down from here. Now, it might not be equal probability, but if it's range bound, I have no idea where it's going, but it's not a high probability play. It's not like, oh my God, this is a no-brainer, right? If it goes down to like the 380, 370 range, that's a higher probability play. It doesn't mean it's going to bounce, but if we're still range bound, you have some chance there for things to bounce and to make some good money. On the top end of the range, you'd say, oh yeah, it's going to keep going higher, but realistically, probably better time to take profits off the table. So I only just point this out just so you can change your thinking that buy and hold does not do well in environments like this. This is where traders do well. Or another thing we've been talking about every week, Doug, is bonds. Now, I don't want to get talking about bonds because people go to sleep, but if you're getting 5.5% on treasuries versus I don't know what I'm getting on my equities for the next 5 years, 5.5% for virtually no risk is pretty darn attractive, Doug. And no one wants to talk about bonds. They're like, it's boring. Where's my portfolio return? Where's my 20%? Like, honestly, if you were in the 6% treasuries you could have got in 2000 and if you held on for 13 years or 15-year treasuries, whatever, you would have doubled your money. You know what you would have made?
That's a lot. That sounds like a lot, Kirk. Doubled my money?
Yeah, 100. That's a 100 number, Doug. That's 100% that you double your money in 100%. You know how much you would have made if you were in this S&P 500 from January 2000 to like July 2013? It was actually negative. Annualized negative return. I think it was annualized like negative 0.3 or something like that. I get it's in that area. It could be a little off, but
that
basically you made no money for 13 years. That's a lot different from 100, isn't it, Doug?
That's a big difference from 100. I mean, those negative signs hurt.
Yeah. So point being is it's really hard. This gets back to time dilation. Time dilation is really hard to look 10 years in the future and say, hey, I'm going to double my money in the next 10 years if I just do this. Versus, I'm going to try to shoot for the moon and maybe lose half. Maybe I'll double it. I don't know. Let's flip a coin. I don't have a coin here. Oh, I got a coin here. It's stuck to the windowsill. It's a dime. It's a dime. It's not worth what it used to be, Doug. Now it's worth like 9 cents. Anyway, it's tails. Anyone pick that? Anyway, so point being is you can't know what's in the future. You can know with some relative definitiveness what bonds are going to do, assuming they don't default. Default is a big problem. Treasuries, low probability of default. So if I know I'm getting 5.5% for the next 2 years at the moment, it could stretch out and could, the yield curve could actually go further and you could be able to lock that in. But for now, that's a pretty darn good rate. I'd be happy to get 5.5% in this market. Now, if the market sells off 50%, I'm going to say, you know what? Sell my bonds, go into equities, right? Or whatever the scenario is. So this isn't like it's going to be like this forever, but if it stays like this, I'm happy to be boring. I'm a boring guy, Doug. People listen to me. I don't know why they listen. I'm a boring guy. Bonds are boring, and that's okay. Making money is not about being exciting. It's not about going to the casino. It's about making boring money. Making money is the most important thing. So let me tip into this one thing, and I'll hand it back to you. So, so inflation is still a big deal, and Doug, you sent me some great ones this week. I did want to point one thing out before we get into inflation. I'm going to let you talk about them because you sent them to me. You should get the joy of talking about the California's new solution to the housing problem. So here's the first thing, and I can't remember if we talked about it last week. This is the velocity of money. Now, you're looking at this, you're probably thinking, what the heck is this? I don't really care. Okay, let me explain it to you. So from pretty much the 60s until the early 90s, the velocity of money was flat. Now, what that means is the amount of money in circulation went around the same amount of times. So $1 went around 1.8 times in a cycle. And that's how they calculate it. It's how many times the dollar circulates. The more circulation, the more money circulating means money's exchanging hands faster. If money is slowing down, meaning it's not being spent, it gets lower. So faster spending goes up, slower spending down. Now that has nothing to do with the economy. I want to be very clear. It's just money. So the reason this is valuable is when this starts to go higher, you should be a little worried, because if it goes higher, it means that people are trading their money faster, which means they don't value the money more than they value the thing that they're spending it on. Now, in the 90s, when this started to climb, that was a good thing, right? Because people are buying stuff. They're buying computers, they're buying tech, they're doing this, they're making more money. It was a boom time. That is normal for that to go up. Now, if you look at it since, it's gone down ever since. COVID, it dropped. It fell through the floor, which you would imagine, right? You're stuck in your home, you're not spending money. Okay. I thought April was the most glorious month that I've had in a long time. I spent no money in April. I had all our, I mean, my wife bought the food, but I didn't have to spend on stuff. I didn't have to spend on gas. I didn't have to spend on hockey gear, nothing, because we were stuck in the house. And I was like, wow, I've got a lot more money. What do I do with all this fun money, right? And everyone else was in the same boat. So obviously the spending went down, the velocity went down, and it was flat, which is interesting because what that means is the inflation is not picking up. And there's more to the story. But if you look at this, you'll notice that in the most recent time, it's actually picking up significantly. It's actually, I would say this is the biggest spike we've seen in the velocity of money since probably the 90s, if not earlier. So big spike in the velocity of money. Now, people look at this and say, oh my God, we're going to have hyperinflation. Not yet. There's another half to this equation, which is the amount of money, right? So if you're going to put together a calculation to see inflation, it's what's the velocity of money? How fast is it going through our society? And then there's the amount. So if you print up a ton of money and you stick it in a bank vault, there's no velocity, which means you're not getting inflation, right? The money in the vault has zero velocity, and it pretty much doesn't exist because no one sees it, no one's using it. Whereas if they printed up $2 quadrillion and gave some to everybody, there would be a huge spike in money being spent because people naturally spend it. And that's what we saw during COVID a little bit. The problem with this is this went down because they printed a ton of money. They doubled the money supply during COVID. So the reason velocity money went down is because a lot of money went out there, but it wasn't being spent. A lot of it was paying down debt and other things. So the point being is the reason why is less relevant. What you need to watch for is this spiking up? And yes, it is. Okay, what do you have to watch out for? Well, is the government taking money out of the system or putting it in? Well, when they create money, you should be worried if this is spiking up. If they're taking money out of the system and this is going up, that's normal, which is exactly what's happening. They're taking money out of the system and this is going up, which means there are fewer dollars in the system that are circulating, which means they're circulating faster because we need the dollars that are in the system. So that is expected. Now, if this starts to skyrocket, I'd be worried. Or if they start printing money and this goes up, I'd be worried. But in the current scenario, I wouldn't be worried. But I'm pointing this out. Honestly, Doug, people are probably bored and they're probably turning off their podcast right now. The reason I'm bringing this up is because I want to come back 6 months from now and say, I told you so to everybody else who didn't talk about this then. Because what's happening is nobody is talking about this. The velocity of money is this mysterious thing that people don't talk about unless it impacts their thesis on the market. This is just an indicator. It doesn't impact my thesis whatsoever. I'm just saying you should watch this. This is interesting. Now, it could get uninteresting once it stops here and flattens out. But at the moment, this is interesting. And remember we talk about in the show when you say, look at something and say, isn't that interesting? This is one of those things. So keep a watch on this. And when everyone else starts talking about it because they listen to the show, now you know where you found it, because this is an important thing to watch at the moment. So, Doug, why don't you tell us what California is doing to solve the housing problem? Because this is genius to everybody except for anybody who's the person who invented this. So what's going on, Doug? Let me show the picture because it's just glorious.
Well, credit to Amy Nixon where I found this on Twitter, but she writes, "Hear me out, prison, but you pay for it." So, people are coming up with these ingenious ideas to make affordability. And we've talked about this before, shrinkflation, right? If you can't raise the price, shrink the package. Well, welcome to the shrinkflation of living. This literally having a concept and an idea of people living in a 4-foot square tiny sleeping pod. So you get up, go to work, come home to your pod next to your neighbor, and the only thing that's separating the two of you is a curtain and a thin wall. And it looks like they're charging, ranging from $500 to $900 per month, which sounds great, except the homeless encampments on the street, I believe, have more square footage to live in. Maybe they're a little cleaner for the moment.
Well, you know what they call these? They didn't invent these. The Europeans did. You know what they're called? Hostels.
Hostels, yes.
These are where college kids go, and they spend $15 a night.
I went to a hostel when I traveled Europe in college. I went to several hostels, and I will tell you, Kirk, and some of the hostels that I stayed in, I actually could have a private room with a door that locked. Compared to this, but what's interesting, they've converted 2 homes and an office space into dwelling for dozens of people. So here's my thinking. If the people that are out there that would consider this, that could afford $500 to $900 a month to live in it, well, $500 to $900 a month couldn't get them a place to live right now. So they're probably homeless or sharing with other people. Are they really going to come up with $500 to $900 a month for the exact same environment in a box? But this is the desperation that we're running into, that the new philosophy of how to overcome these exponential costs, especially in living, and the things that we need is to shrinkflate your living. But you don't even have the security door to lock when you go to bed at night. I don't even know. I don't really have anything more I could say about this. Is just absolutely stupid upon stupid. But it does tell you, the desperation that we're getting into, that people are getting into, to come up with solutions to resolve a problem that is absolutely astronomical. I saw something the other day that said, it basically was the shrug of I don't care anymore, right? It said, well, do 8% mortgages really matter when the cost of purchase is unaffordable to begin with?
Yeah.
True. I could charge a 25% mortgage if nobody can go out and get it in the first place, right? So, and I think this, again, this comes back to the fact that banks are only going to lend what you can afford in your cash flow. A reminder to those that have maybe new here or have listened to this before, a mortgage is not not money that's being lent against your property. So you come up to them and say, hey, I've got this property. It's collateralized. It's worth this. Give me the money. The bank's going to laugh at you. The banks are only lending against income. That's why you got a stack of paper this big. And they're basically, what they're trying to find out is one thing, which kind of tells you the mortgage industry is the dumbest thing in the world. Anyway, if you think about it, all they're doing is saying, they're not asking, can you pay us off? They are literally qualifying you to ask, can you pay at least the first month? Because that's what it is. Does your income afford this payment? Well, we all know that all that matters there is based on the income you're bringing in at this moment, right? You could lose your job in month 2. They are qualifying you based on your ability to pay the first month's payment. That's all it is. Now, the banks know that there's some risk there, Kirk. They know it's slightly a lower risk because when it comes to the end of the day, whether you've got credit cards, you've got student loans, you've got auto payments, what is the last payment that you're not going to pay? It's going to be your housing.
Your house.
Right. Yep. You'll let your electric bill shut off. You'll let your heating bill shut off. You'll let your credit cards go into default. You'll do everything you can before you will let your housing get taken out from underneath you. And the banks understand this, so they recognize that there's a limited amount of risk that they're taking. Even if you were to lose your job, they know that there's a high probability that you're going to go into that next month and pay that mortgage payment. But just in case, why is it tied to a house? Because it's one tangible secured asset that the bank can then attach to be able to grab a collateral to pay off the debt for those that are in the worst situation that don't pay it, that don't pay their loans. But the banks don't want your house. And at the end of the day, this was never designed to be a loan against your house. It's designed to be a personal loan on your income. And I think people need to understand that. And that also means that if the collateral isn't able to cover the loan, the bank is not going to give that loan to you, because they're still going to make sure that the maximum amount they lend you is going to be secured by that collateral. And that's why there's some argument to this. If loans are at 8, 10, 30, 100%, it ain't going to matter anyway if the bank isn't going to approve the loan in the first place. If the house you're trying to get is a $1.5 million house, or you're trying to get a $1.5 million loan, and ultimately your income can't afford that, and ultimately at the end of the day, that house is falling in value, and nobody's selling it, and the price are coming down anyway, the loan won't get approved. Okay, so we are really at a stall right now, and this leads to the next thing, and that I want to talk about is, where does this fall into the scheme of things? This is one of those added costs that is now just absolutely slamming into the budgets of your everyday personal business, because that's what your personal financial wealth is. It's a business. We are all business owners, right? You either own a business that is a company, or you own the business of your household, and it runs the same way. You got to bring in more money than's going out, and you've got to use other people's money to cover that. Well, what's happening right now is they just came out and announced that the Social Security cost of living adjustment for next year the hike shrinks to 3.2%. And as we've talked about with regular inflation, and this is as Kirk, I said this to him the other day, he goes, "Isn't that the CPI?" Absolutely is. That's what the federal government uses to determine cost of living adjustments for things that they have to pay obligations on as well, which of course some would argue that gives a very big reason as to why the government is tinkers around a little bit with these, because it's not only, a sign of what the economy is and what people are paying, but it also directly relates to obligations that the government has to pay. And so inflation went up. It has not gone down. We have not had deflation. We've had a reduced volume inflation. I apologize, Kirk, the term for that. Thank you. Disinflation. We've had disinflation, meaning that it's still going up just at a lesser amount. But here's the reality. And we've talked about this, and I think these numbers show a very, very clear picture that while the CPI went up only 3.7, if we look at basic necessities, these are the things that people cannot generally turn off. Okay. Those things are going to include repairing your car. Okay, because if you have a car, you may not go out and buy a new car, but you got to keep that car running. That's up 10%. Car insurance inflation. Guess what? You're going to have to actually legally have insurance, which means we're going to start to see more people driving uninsured. That's a problem. That's gone up almost 20%. By the way, I saw something the other day where somebody posted that their mortgage payment just went up by $900 a month. There is a belief out there that mortgages are fixed. There's a belief out there that if you pay off your mortgage completely, that you own your home outright. Well, guess what? Why did his payment go up $900? Because right now, with this massive spike in tax revenue, with this massive spike in valuations on houses, they're having a very difficult time accounting for what property taxes and what property insurance is actually going to be and therefore, guess what? Escrows are not keeping up with actual costs. So they came back and got a $900 a month assessment to make up for I think it was a $12,000 shortfall on their escrow. Now, you could probably venture to guess where this was. Most likely this was California or one of the large expensive coasts. But the point is that this is an inflation I don't think people are accounting for, because they're saying like people are going to stay in their homes. Why would they move when they've got this fixed mortgage payment? Well, guess what? If that fixed mortgage payment was based off of a budget right now and that they're going to keep, but they get a $900 a month spike on homeowner and property taxes, they're no longer going to be able to afford to keep that home, even if they're locked in at 2.5%, because that payment has now changed by $900 a month. And that is incredibly damaging to household finances. Transportation inflation up 9.1, rent inflation up 7.4. As a matter of fact, we've hit all-time highs on rent. Meat and poultry inflation. Ironically, Although pork prices, I believe, are at some of the all-time highs. Overall, 4.8%, not bad. I just saw that orange juice hit another record again. Food away from home inflation, so that would be obviously eating out anywhere else, 6%. So yes, we are seeing a decline in the overall increase in overall costs. But again, that takes into consideration plasma TVs, which people may not be running out and buying. They are paying for these things. And now you look at possibly a spike in monthly payments for mortgages. You look at the addition that we've talked about of student loans that were in deferment coming back. You start to look at other areas. This is something that I would look at very, very closely. Is, as I just said, mortgage payments or rent payments are going to be one of the last things people are going to try to get behind on, because ultimately people want to have a roof over their head. But if we start to see people drop homeowners auto insurance, we start seeing people drop other types of insurance, we start to see delinquencies in mortgages go up. It may not look like much if it's a small spike, but it's a sign of a much, much bigger problem, because if we're seeing it move at all, it means that there are more people that are out there that are close, if not already falling behind in all these other areas first. Okay. And ultimately, at the end of the day, that is incredibly bearish from an economic standpoint, because we go back to the philosophy of money. People have to spend more. And I think that, Kirk, I want to go back to the chart you said before. I think one thing that two things I take out of that chart. Number one, you saw the 2020 decline. You see it come back up. Well, if we look at a linear line that still looks, at least so far, to be following the path of decline that we were already seeing going back to, it's hard to see, 2005 to present, right? So not much of, we're not venturing off that. But if we do see a spike, I'd be really concerned for another reason. It's because it tells me it might be a little bit of apathy. And apathy can be very dangerous, because what's happening is now we know the government's not injecting money in the system. And you said that would be something you'd be concerned about. But if they're not injecting money in the system, if people are losing access to capital, if they're having trouble with accessing, but then all of a sudden we start to see spending go up, it could be on a bullish sign. We're starting to just adjust to the changes. And as long as they're constant, the economy can adjust from that. But if it happens too quickly, it could just be people giving up, right? There's so much of this negativity, so much of I can't afford it, forget it. I'm just going to go out and spend money on credit cards and other debt, however I can, until it hits a limit. And that's when things, unfortunately, implode.
Yeah. This is all really important. And I think that, to your point, Doug, we've got a lot of things that are out of balance. And I saw a funny meme. I wish I could find it. I'd share it on the show. If I can, I'll put it in the show notes. But it was a picture of a chart where it showed inflation, which, if you take the cumulative last few years of inflation, it was a lot. And then it showed like people's income. It was like, inflation was like whatever it was, like 20%, let's say. People's incomes went up 5%. And it just showed this massive difference. And then there's a guy in a rocket, and his face was Paul Krugman. So I thought it was just hilarious. But it was like, yeah, great. And his comment, because I think he made a comment the other day of like, oh yes, inflation, we've got it under control. It's like, yeah, okay, it's not going up now, but what about the last few years where you had that discrepancy between price of goods and the wages, right? So if goods go up 50% this year, and you're like, oh, that's so crappy, and then next year they don't go up at all, and you're like, oh, we took care of inflation, like, yeah, but my salary hasn't gone up. So it just means that it hasn't solved the problem, right? My salary went up 50%, I'd say, okay, whatever, it's the same. But people are, it's why I hate politics. It's all give or take. It's all a little bit of this, a little bit of that. It's not really nothing really about the truth. But I did want to point it out, because I think there's some things in there you should understand. Now, there's one piece here that I do want to share, and this is something I saw the other day and I was fascinated by, because no one's really talking about this. So this is, and to show you, it's basically two charts on top of each other. One is Baker Hughes crude oil rig count. So really, it's the rig count, the number of rigs out there producing oil, right? So that's the green line. And then you've got the blue one, which is the crude oil total production data. Now, if you notice, there's a lot of correlation here, right? And obviously, if there's more rigs, you're going to get more production. So you could say it's causative as well, because you're not making oil from nothing. You're making it from rigs. More rigs equal more oil, less rigs, less oil. There's a causation there too, a very direct causation, but there's also obviously a lot of correlation, which it's not 100%, but it is there. So if you look at this and say, wow, the oil production data just went through the roof in like the last few months, it's like, holy crap. And then the rig count is not. The rig count's going down. So I just pointed out because it's like, isn't that interesting? Now, it could be a lot of reasons, but it's just kind of like that's interesting. I should look into that. So I just saw this. I wanted to point out to the listeners because I thought it was fascinating. Like, this should not look this way, but I need to dive in and talk to a few people, figure out why that's happening. There is something going on that if you haven't driven your car in the last few months, you might not have noticed. But gas prices are starting to go up, as have oil prices. And so what you need to know is this is a big part of inflation. So if you haven't been paying attention and you haven't noticed gas prices are climbing, you should pay attention because it's kind of important if you drive to work, especially for people who are on the margins, who are barely putting food on the table, and now gas prices are going up. So they bounced down a little bit in the last few weeks, but they're definitely in the higher end. And so what's interesting is it's going into election season. That's a year from 2 weeks from now. It's a year away. And in election season, people are trying to, they call it window dressing, right? They're making everything look good. I hope the market goes up next year, so I look good and I get reelected and all these other things that happen. And there's a lot of political window dressing that goes on. But what you should understand is that the oil problem we have is in large part stemming from our policies. Now, we have had a country with a tremendous amount of oil wealth. We've had it for a long periods of time, and we have administrations that are pro or against oil. And this is, forget the green part. I know there are people out there like, yeah, but it's not green. Great. I understand your argument, and it's not about that. But there's a good question I'll try to answer here in a minute. So let's forget the green argument. Let's forget the global warming. That's not what this is about. Okay. So just try to take your bias out of the picture so we can have this conversation. Now, if you're looking at oil, we run on oil, plastic, drive the car, all this stuff. This runs on oil. It doesn't run on fusion. It doesn't run on solar panels. It runs on oil. And while we may want that to be different, it isn't different today. That's why I'm saying ignore all that stuff, because it's not doing anybody any good in this conversation. Okay. Now, maybe we have solar paneled planes in the future. I don't know. But today we don't. So looking at that, oil plays a big part in our economy. And this is a big problem in the 70s. We had an oil spike. People couldn't get gas in their car. Terrible. Now we've got a war going on, or almost going to be, it'll probably end up being a war in the Middle East because of the Hamas attack on Israel, which was horrific. And I mean, the stuff going on, that's why I don't watch the news. Just the stuff out there is just ridiculous. So, but I could tell you that whatever the truth of it is, I wasn't there, is that there's probably going to be a war in the Middle East. Israel is not happy about the attack. Let's put it that way. So that means that there's probably going to be a spike in oil prices, and that's going to hit us in the wallet. So our policies here of we can't produce oil because it's polluting the environment, that's great 10 years from now. It's not great today. All you're doing today is causing inflation. You're causing people to have less money. So for all those people who are voting for these policies, and you don't care that you're paying a lot more for your gas to heat your home, good for you, right? But there are a lot of people in this country who do give a crap about that because they can barely put food on the table. So if you increase their heating bill by 100%, they're not going to be able to put food on the table. So try to be thoughtful about the people who are on the margins who really are getting harmed by this. For people in the middle class, upper middle, they're probably going to be okay with this bump, but a lot of people aren't. So think about what's more important, making sure that people in this country don't starve, or figuring out a problem 20 years from now that is not getting solved today. And if you had technology to solve the problem today, What would that be? Oh, I know. We do have technology. It's called nuclear, and we don't use it. So the second that we start talking about nuclear, they'll say, "Okay, great. I'll entertain your arguments about global warming. Like, if you want to solve it, it's there, but we don't want to solve it. We want to talk about it. We don't want to solve it, and that's the truth of it. And that's what frustrates me about the whole issue is that we don't want to solve it. We want to talk about it. So if we want to actually put food on the table today, it's going to require oil, which means that we should have policies that help the oil industry, or at least transition it realistically, right? So if you just say you're not going to produce more oil, and you're going to make it disadvantageous for the industry to operate, then they're going to say, sorry, we're just not going to put we're not going to put rigs online because you're just going to tax us and you're going to do all these nasty things. So read between the lines, government. And that's basically what they're doing. And so oil prices are spiking. They're like, oh, why is oil price so high? Could it be our own policies that are causing that? Well, it's political season, so they're not going to say it's their fault, but I'm just telling you here, it's their fault. Policies have to do with a lot of problems in this country, good and bad, right? And there's good things that come out of politicians too. I just can't name one off the top of my head. So anyway, Doug, final thoughts from you before we wrap it up. Oh, question. You want to handle this, Doug? You want me to do it?
No, go for it. I think you're a little closer to those kind of currency conversations than I am.
Okay, so we have a question from Whitney. Thank you for the question, Whitney. Are we able to gauge how unregulated currencies play into this, which changes the entire story? I'm not sure which story we're talking about, whether it's cryptocurrencies. You're talking about which story are we talking about? Global warming.
It came in right after we were talking about the M2 and kind
of
inflation.
Okay.
So it might have been tied to that.
Okay, perfect. Thank you, Doug. So the question having to do here with unregulated currencies, the velocity of money. That's a great question, and it's one that actually I've never heard anybody ask. So you get two. Doug, 2 thumbs up from you. We get 4 thumbs up here. Come on, Doug, show us your thumb. There we go. You get 4 thumbs up for that question because no one's even asking that question, and it's an unbelievably thoughtful question. And I'm not just saying that to blow sunshine up your skirt. It was really good. So
we said we were going to stop lying after the opening introduction. So everything now is truth.
No, it's factually that is a wonderful question. So the way to think about it is think about it in terms of ratios, right? So if there's $1 trillion in circulation, and there isn't, there's more than that, but let's say there's $1 trillion in circulation, okay? And then you introduce, let's make it simple because trillion's so big. You have $100, 100 ones circulating in an economy. It's just me and Doug, we got 100 ones circulating around, and we're trading things back and forth to buy our goods and services and whatever. And then you introduce 50 ones worth of Bitcoin as an example. Well, yes, that is going to impact the money supply. It's going to impact the velocity of money. It's going to impact all of it because you have basically a currency or something that's being used as a currency, the same thing. So the dynamics should be the same because it doesn't matter if you're using a dollar bill or a token. You're exchanging value for other value. Right, is all you're doing. You're bartering with paper, right? Paper is stored value, right? So the paper has value because we all deem it as having value, but it's just paper, right? So you're changing one stored value for another stored value. And so if you introduce a whole lot of things into the system that people are using as currency, it will absolutely impact these numbers. Now, the question is, here's the follow-up question. Are they calculating the unregulated currencies as a part of their calculus? And the answer is no. So is it going to impact this? Yes, but only because it's not being calculated properly. Because if half the country uses Bitcoin, the other half uses dollars, you have half the country that's not being calculated because they're not including it. If they include it, then you could see if it's being if it's affecting or not. Now, my guess is that cryptocurrencies are such a small part of the economy that it is not really impacting the story. Now, there is an impact, but the degree is probably so small that you're not going to notice it. So it's a great question, but putting it into context of if it became a big part of the economy, it would absolutely move the needle. And it probably, knowing the government, is not going to monitor it openly. They might privately, but not openly monitor it. So they don't really know if it impacts the metrics. So I think there's a great question. I think there's a lot of follow-up questions that need to be answered, but the simple answer is proportions. Is it proportionally big enough to make a difference? If it is, and people are using it, and I will point out, using Bitcoin as an example, because it's unregulated, I will point out that Bitcoin, a lot of people own it and they don't use it. They're just storing it in cold storage because it's going to hold value for later. A lot of speculation goes on in Bitcoin, a lot more than actual usage. I've got Bitcoin. I don't have much. Like, I played around with something that was like $50 or $100 a bunch of years ago, and maybe it's worth 200. I don't know. It's not very much, but I did it to experiment with some things, and it's just sitting there. I'm not using it. Should I use it? Maybe, but where am I going to spend it? I'm not in the Bitcoin community. So there are people who are into this and they're spending it and they use it in their daily life, and that's awesome. I love that people are doing that because there's no better way to get it instituted than actually use it. But I don't use it. It's just, for me, it's a speculation on a thesis, and it works. And but I think if you take the context of the amount of unregulated currencies and then the amount of actual usage of it, it's like 1% of 1% of 1%. So I think it's just too small of a number to move the needle. But awesome question. Thank you.
I agree with you completely on that, Kirk. And just not because I know we're at the end of time here. I agree. It's not that big in our economy. Think about where Bitcoin or cryptocurrencies are accepted right now. Yes, there's been some big things in the news like, oh, this company's going to start accepting, this company's going to start accepting it. But for the most part, most companies still don't. And most people don't have it to use. So it's probably such an insignificant number at this point. But over time, again, if they're here to stay, if blockchain is here to stay, and especially in currencies, it will become a greater and greater impact to that. But I don't think at this point it's significantly measurable yet.
Awesome. Well, Doug, wrap it up here. Where can people find more about you?
Well, thanks. Listen, one of the biggest the areas of inflation is college planning. And here's the thing, people, it's stressful. There's a lot to do. There's a limited amount of time, and that wall is coming at you, and you're in a 75-mile-an-hour car, maybe a 100-mile-an-hour car, screaming at it. If you've got a child that's in high school, waiting is not going to help you. And the later you delay, you could lose up to $30,000 to $50,000 of money that you could be using towards college. This could impact almost $200,000 of a retirement. You need to get the information you need to make smart decisions with your money. And if that's who you are, then make those smart decisions with your money by going out and get the information. Go to our website, procollegeplanners.com, or reach out to us at info@procollegeplanners.com right now, and get the information you need. Ask us any questions you need. We'd be happy to help you.
Awesome. Well, Doug, once again, always enjoy having you here on the show. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On their website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.